Have you ever wondered why the value of Bitcoin surged 150% coming into 2024? The answer lies in the exciting landscape of cryptocurrency and the dynamic factors that influence its market value. Let's start with the term bull market. A bull market refers to a market condition where the prices of securities are rising or are expected to rise. It's called a bull market because just like a bull charges with its horns up in the air, the market is on an upward trend. In this context, Bitcoin's value surge is a clear example of a bull market in action. One of the key drivers of this bull market is the approval of spot exchange-traded funds, or ETFs. In simple terms, an ETF is a type of investment fund and exchange-traded product that is traded on a stock exchange. Spot ETFs, more specifically, allow investors to directly buy and sell the physical asset, in this case, Bitcoin. The approval of these ETFs open the doors for more investors to enter the Bitcoin market, driving up demand and subsequently its price. Another significant factor contributing to Bitcoin's boom is the upcoming Bitcoin Halving Event. Now, what exactly is a halving event? Well, Bitcoin operates on a model where every 4 years roughly, the reward for mining new Bitcoin is cut in half. This effectively slows down the rate at which new Bitcoin is introduced into the market. With the supply of Bitcoin dipping and demand remaining strong, the price naturally goes up. It's a classic case of supply and demand. These two factors, the approval of spot ETFs and the upcoming halving event, are major influences on Bitcoin's current bull market. They've stirred up interest, excitement, and a dash of uncertainty, making the world of cryptocurrency an intriguing place to be in 2024. So the bull market and Bitcoin's halving event are key contributors to the current state of the crypto market. As we continue to explore the world of cryptocurrencies in our next segments, remember that this market is as volatile as it is vibrant. Stay tuned. Have you ever thought about how the growing attention on the cryptocurrency market could lead to increased regulation? As the cryptocurrency market matures and becomes more mainstream, the spotlight it's getting from regulatory bodies is intensifying. Remember, unlike traditional financial systems, cryptocurrencies operate on decentralized platforms. But with the rise in crypto use, concerns about consumer protection, illicit activities, and financial stability have emerged, drawing the attention of regulators worldwide. Regulatory bodies are keen on ensuring that cryptocurrency transactions are not used for illicit activities, such as money laundering and terrorism financing. They are also interested in protecting consumers from the high volatility and potential fraudulent activities associated with cryptocurrencies. As a result, we are seeing an increase in the introduction of regulations aimed at making the cryptocurrency market safer for everyone. What does this mean for the future of cryptocurrencies? Well, increased regulation could have both positive and negative implications. On the one hand, it could help legitimize cryptocurrencies, increasing their acceptance by traditional financial institutions, and potentially leading to more widespread use. This could boost the overall value of cryptocurrencies and the crypto market. On the other hand, one of the key appeals of cryptocurrencies is their decentralized nature, which grants users a degree of privacy and freedom not usually found in traditional financial systems. Too much regulation could stifle innovation and restrict the freedom that cryptocurrencies offer, possibly leading to a decrease in popularity and value. In addition, the complexity and diversity of the crypto market present significant challenges to regulation. Different cryptocurrencies function in different ways, and what works for one might not work for another. So regulators will need to tread carefully to ensure their rules are effective and don't stifle the growth and innovation of this promising market. Therefore, the increased regulation of cryptocurrency and exchanges is another major factor influencing the crypto market. Whether these regulations will prove to be a boon or a bane for the world of cryptocurrencies is still up for debate. But one thing is certain, regulation is becoming an increasingly important part of the crypto conversation. And as we move forward, the interplay between regulation and cryptocurrencies is something we'll all be watching closely. Have you considered how the increasing use of cryptocurrencies impacts the environment? As the world grapples with climate change, every industry, including the digital sphere, is under scrutiny for its carbon footprint. Cryptocurrencies, while innovative and increasingly popular, are no exception to this scrutiny. Let's break it down with a simple fact. The mining of cryptocurrencies, especially Bitcoin, requires a massive amount of computational power, which in turn demands a significant amount of energy. This is because the process of mining involves solving complex mathematical problems to validate transactions and add them to the blockchain. The higher the demand for cryptocurrencies, the more computational power is needed for mining, and consequently, the greater the energy consumption. Now, you might be wondering, what's the big deal with this energy consumption? Well, the source of this energy is the crux of the issue. If the energy comes from renewable sources, the environmental impact is relatively low. However, a substantial proportion of crypto mining is powered by non-renewable sources, which are notorious for their high carbon emissions. In fact, it's estimated that the carbon footprint of Bitcoin mining is comparable to that of some countries. This environmental concern is not just theoretical, it's already influencing the cryptocurrency market. For instance, Tesla, once a major proponent of Bitcoin, reversed its decision to accept the cryptocurrency as payment due to concerns over its environmental impact. This decision caused a significant ripple in the market, showcasing how environmental considerations can directly affect crypto's value and acceptance. As we move forward, we can expect this trend to persist. As society becomes more conscious of our environmental responsibilities, cryptocurrencies will need to adapt. Solutions might include shifting towards more energy-efficient mining methods or incentivizing the use of renewable energy in mining operations. Indeed, the growing climate impact of crypto is a key trend that could shape the future of the market. As we continue to navigate this digital frontier, it's crucial to remember that innovation and environmental sustainability are not mutually exclusive. They must go hand in hand. Did you know more and more real-world assets are being digitized using blockchain technology? This fascinating trend is transforming industries and redefining how we perceive value. To break it down, real-world assets can range from physical items like real estate and artwork to intangible assets like patents and copyrights. These assets are being tokenized or converted into digital tokens on the blockchain. This transformation process is often referred to as tokenization. So why is this happening? Tokenization offers several advantages. It enhances liquidity, meaning assets can be bought, sold, and traded more easily. It also brings transparency and security, as blockchain's immutable nature ensures that every transaction is traceable and cannot be altered or deleted. Imagine owning a piece of the Mona Lisa, or a share of a rare vintage car. This was unimaginable a few years ago. But with tokenization, these assets can be divided into multiple ownership stakes, allowing more people to invest in them. This is the power of tokenization, and it's democratizing investment like never before. But it's not just about investment. Tokenization is also revolutionizing industries like supply chain management, where it's providing end-to-end visibility and eliminating inefficiencies. It's being used in the music industry, enabling artists to tokenize their work and retain more control. However, this revolution is not without challenges. Issues like regulatory uncertainty, technological complexities, and the need for robust legal frameworks are hurdles that need to be overcome. But as the technology matures and these issues are addressed, the scope for tokenization will only expand. In the near future, we could see everything from real estate to intellectual property, even personal data, being tokenized. This will fundamentally change how we own, trade, and interact with assets. Thus, the digitalization of real-world assets is a growing trend influencing the crypto market. It's an exciting world out there, and it's only going to get more interesting as we move further into this digital age. Do you know about the increasing interest in central bank digital currency among global officials? Central bank digital currency, also known as CBDC, is a new concept in the financial world that's rapidly gaining traction. It's a type of digital currency that could be issued and regulated by a country's central bank, just like traditional money, but in a digital format. Imagine your dollars, euros, or yen, but in a form that's entirely digital and designed for our increasingly digital world. Just like physical currency, a CBDC would represent a claim on the central bank, providing a safe and liquid payment instrument. Now, why is there so much interest in CBDCs? Well, the primary reason is that it combines the convenience and security of digital forms like cryptocurrencies with the regulated, reserve-backed money circulation of traditional money. The potential implications of CBDCs are vast. For starters, they could boost the efficiency of payment systems and reduce the costs associated with the creation, distribution, and management of physical money. Secondly, CBDCs could potentially provide a more inclusive financial system. For those who are currently unbanked or underbanked, CBDCs could offer an accessible entry point into the financial system, fostering financial inclusion and economic equality. But it's not all rosy. There are challenges and concerns too. Issues like cybersecurity, digital identity verification, and the potential for increased surveillance by governments are all crucial considerations in the development of CBDCs. Despite these challenges, many countries are actively exploring the potential of CBDCs. China has already started pilot programs for a digital yuan, and many other countries, including the United States, are conducting research and considering their options. In conclusion, the exploration of central bank digital currency is a trend that is set to shape the future of the financial world. As we look ahead, the rise of CBDCs could bring about significant changes in the way we think about money and conduct transactions. So the exploration of central bank digital currency is a trend that could further shape the crypto market in the near future.